Dear viewers, welcome to yet another edition of Your Life, Your Money. Today I have come to you with a topic of taxation of debt mutual funds. In the recent Finance Act, Government of India has brought amendment to the way the debt funds are going to be taxed. They are no more as attractive as it used to be before from a taxation perspective. In this episode, I am going to examine should you stop investing in the debt funds from here onwards, or you should continue to stay invested in the debt funds. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Before this year's Finance Act 23, debt funds had enormous tax advantage. They had short-term capital gains provision and they had a long-term capital gains tax provision. Under the long-term capital gains tax provision, they had an indexation benefit, and the charge structure post-indexation was 20%. What has changed now? Now the thing that has changed is they have lost that long-term capital gains advantage. They have lost the indexation benefit. From here onwards, from 1st of April 2023, the debt funds will attract taxes in accordance with short-term capital gains, which means to say, whatever the gains that you make from the debt funds will be added as your income and it will be taxed at the appropriate slab rates. This was a shocking news for the market. Debt funds have become very popular over the years. Mutual fund industry has colossal assets of debt funds in their portfolios. The change in taxation, nevertheless, in a way spooked the investors. Should I stop investing in debt funds because the taxes have changed? Let's examine these points step by step, point by point. First point to make note here is debt funds of the mutual fund still continue to remain as the capital gains tax. It will not be treated as accrual tax or direct income tax. Let me explain here the difference by taking bank FD as an example. In case of a bank FD, let's assume that you have kept 1 crore as the fixed deposit and you get, let's say, 6% as the interest income. Whether you take out this interest or not, at the end of the year, while filing the tax return, you have to take into account the entire 6%, which is 6 lakhs, as your income of the year and add it with other incomes that you would have had. And you should calculate your slab rate and you have to pay taxes. It means it is coming directly under income tax on your accrual basis, whether you have consumed it or not, whether you have redeemed it or not, whether it is still continue to accrue interest, you have to pay taxes. You have to pay taxes then and there itself. Whereas what happens in case of debt funds? In case of debt funds, even after this tax enactment, it still remains as capital gains tax. That means, let's say that you have invested 1 crore in the debt fund instead of an FD now, it will continue to rise in value because the NAV is rise. Why NAV is rise? NAV will rise because of the coupons the debt funds will collect, as well as if there were to be gains made because of trading in the bond portfolio, interest rate rise, interest rate keep falling down, and the fund managers can make money out of interest rate changes. So your NAV increase will not directly bring taxation to your annual taxation. It will come under taxation only when you redeem this. In a bank FD, you have got the interest, you have to pay the taxes. That means for next year, effectively the amount of money which is available for you to reinvest actually comes down. In case of debt funds, as long as you do not redeem for n number of years, it will not suffer taxation. Let's look at somebody building a portfolio for long term and they don't sell it for 5 years, 10 years, 20 years, 30 years, 50 years. Till such time, you don't need to be paying any taxes on the debt funds of the mutual fund. That means you can make effective use of this deferred taxation to increase your return. Yes, long-term taxation has been taken out, but still there is a tax arbitrage in case of debt mutual fund. There is one another aspect. In case of bank FDs, The interest comes on accrual taxation. Here, in case of debt funds, you can control taxation. Let me explain this point. Now let us say that you have kept 1 crore as the portfolio of debt funds and 10 years you will not touch. After 10 years, you decide to redeem this. You don't need to redeem all the money in one day. You can redeem as per your needs. Finally, you redeem based on your needs. Suppose you don't need that money, you can control redemptions. You may take out, let's say, 3 lakhs per year or 5 lakhs per year. You can check what is the income tax slab for that particular year. If you have redeemed within that, then you have a chance that you can still bypass the tax. Or let's say that you could be in a 10% tax bracket. Then even after redemption, some portion can be tax free and some portion can come under the lower tax slab. So you can control redemption, which means to say you can control the taxes that you pay. That option is available for you in the debt funds. Whereas in case of a bank FD, that option is not available. Yes, taxes have come on the debt funds, but that doesn't mean there is no tax arbitrage here. The tax arbitrage still continues to exist in the debt funds of the mutual funds. Taxation is not the only attraction of debt funds. Debt funds have got multiple attractiveness. People use debt funds for various reasons. For example, in case of a bank FD, you have a tenure which is built into it. The return what you get is a function of how much is the tenure you are prepared to pack into that FD. If you take a long-term FD, normally long-term FDs will give you higher rate of interest, and if you put it for short-term, you will get a lesser interest. Yes, the current phase is slightly different. We are in a different interest rate trajectory right now. Could be the short-term rates are higher now and the long-term rates are lesser, but that's not the way all the time it works. Most of the time, short-term rates are lesser and the long-term rates are higher. So to get a higher yield, you have to lock in for longer periods of time. In case of debt funds, you have no tenure. You have put this money to use in an open-ended structure. That means you can keep it for unlimited period of time. You can take it out anytime you like. So these are the options which the debt funds will offer you, whereas the bank FD will not give you that offer. There is another attraction. A bank FD, if you need money, you have to break the entire FD. Let's assume that you have made one FD for 1 crore rupee and your need of cash is 25 lakhs. Then you have to break the entire 1 crore FD to get that 25 lakhs. So you have a reinvestment risk there. The alternative could be you can tell a bank manager, I need 25 lakh. Bank manager may say, okay, I'll give you an overdraft and against which you can take 25 lakhs. So a certain degree of illiquidity or certain degree of not able to maneuver the way you want gets packed in a bank FD. Whereas in case of a debt funds, it is liquid at all times. It is flexible, it is divisible. You have kept 1 crore, you want 500 rupees, you can get it. You want 5,000, you can get it. If you want 50 lakhs, you can get it, or you can liquidate the entire amount. That flexibility feature is not available in case of a bank FD. A bank FD is one type. Either you have a long-term FD, medium-term FD, or a short-term FD. Whereas in case of mutual funds, the debt funds are available in variety of fashions. For example, now you have short-term funds, you have medium-term funds, you have got long-term funds, you have got the gilt funds, you have got the credit risk funds, you have got the corporate bond funds, you have got the PSU funds, you have got the dynamic bond funds. So multiple types of debt funds are available for you. You can choose the debt funds which suit your requirements, which suits your risk profile. You can choose which is in fashion, which is likely to get you a better return. You can choose that. That flexibility is not available for you when you go through a bank FD. So this is one another advantage of debt funds. The next advantage is it is definitely possible that the debt funds can give you a better return than your fixed deposits. How can the debt funds give you a better return? There are two ways it can happen. One, a little bit of a risk that can be taken in the portfolio, and it can add a little bit of additional return to your portfolio. Again, it's a fund manager's job. They will do the job of getting a better return for you. The other way is playing around with the duration of the funds. The bond funds are volatile because of the duration that is built into these funds. Long-term bond funds are highly volatile. The short duration bond funds are less volatile. All of us know that the interest rates will move in a cycle. Now this creates an opportunity for a fund manager to alter the duration in the debt funds and create an alpha or a better return. Let's say now we are at the top end of the interest rate cycle. Maybe interest rates will stop here or maybe marginally move up, but it is obvious that 1.5 years down the line, interest rates will move down. Now, if the fund manager is able to move into long duration bonds in his portfolio, and when the interest rate fall, the bond prices will rise, as a result of which bonds can give you a higher rate of return than a fixed deposit. The dynamic bond funds, where the fund managers have a wider mandate to alter the duration of the funds, are the funds where this kind of maneuvering is perfectly possible. So debt funds can beat bank FDs in giving you the return because of these two factors that I discussed with you. Debt funds have got one distinct major advantage. If you keep money in the bank fixed deposit, you are lending money to the bank. Nothing will happen, your money is safe. The deposit insurance is for a limited value of 5 lakh rupees, right? And your entire investment goes through a concentration risk. That means you put, let's say, 1 crore in a bank FD, you are insured for 5 lakhs, and the 95 lakhs is uninsured fixed deposit. For any reason, if the bank goes belly up, which it will not, your money is at risk. Whereas from a diversification perspective, the money which you have invested in the debt funds is more secure, more diversified. If things were to go wrong, it will not go 100% bad. It can have problems. See, some bonds might default. That possibility exists. But when you invest money in a debt fund, your monies are invested into hundreds of different bonds, and all these bonds going for default is not possible. So your debt funds appear to be more safer than a bank FD itself. Dear viewers, you might be knowing that we are the mutual fund distributors in India. We have a team of experts on the ground who look after various aspects of investment. If you are a person who is looking out for professional assistance to invest your money, to reach your life goals, to build your retirement corpus, or to create wealth using different instruments, you can make best use of our services. Our services have many instruments in it. We plan with your insurance, pension funds, fractional real estate, mutual funds, stock advisory from our team of experts who are associated with that. So many activities can be done using NRI Money Clinic now. If you have an intention, you can reach out to us through a very simple process. I've shown my number here on the screen. Send us a WhatsApp message and my team of experts will help you to build wealth as needed by you. Don't hesitate, send that message now. Do you use debt funds in your portfolio only for the sake of taxation or only for the sake of return? The answer for that from a professional point of view is no. It's not only taxation, it is not only return. There is something called asset allocation. You must be aware about what is asset allocation. If you have certain amount of money to be invested, it should be spread into different asset classes, maybe debt, maybe equity, maybe commodities, maybe precious metals, or any other asset class. Asset allocation is an established principle of financial planning. Just because equity gives you high rate of return, you don't go and park 100% of your money in equity. Likewise, you don't put 100% of your money in the fixed income. So the professional financial planners know their job very well, and if they sit with you and agree on a portfolio, they invariably use the asset allocation tools, and they will fix how much of your money has to go into the fixed income, how much of money has to go into other asset classes like equity, gold, and other things. Asset allocation is sacrosanct. That means you're not supposed to violate the asset allocation, because markets are going through a bull run, so you don't change your asset allocation, or for other reasons you don't change asset allocation. So are the case of taxation. So when you build a portfolio, asset allocation becomes the cornerstone of building your portfolio, and debt funds, fixed income is a major portion of asset allocation. Just because tax structures have changed, you will not change. Yes, obvious, the financial planners will work towards negating your taxes or minimizing your taxes or managing your taxes to the extent possible. But that will not come at the expense of asset allocation, because if things were to go wrong, what saves you is the asset allocation, and that cannot be thrown out of the window just because tax structures have changed. I would like to make a comment here about taxation. If there is anything which is certain in life, one, change is certain, death is certain, and changes in taxation rates periodically is also a certainty. We have to live in this environment. Tax structures keep changing. You don't change your planning as per the taxes which are changing in the system. Let's look at what changes have come in the last few years. Till 2018, the capital gains coming from the stocks and the mutual fund was 100% tax free. Then in Mr. Jaitley's budget, he imposed 10% capital gains tax on the mutual fund and the stock investment. Did anything change? Nothing. The industry grew from there onwards. Then in the year 2021, unit-linked insurance plans had enormous amount of tax arbitrage around it. You put money in the mutual fund, you have to pay 10% taxes. You invest in the unit-linked insurance plan, it has a 100% tax arbitrage. The government said ULIPs will come under capital gains tax. What happened in the industry? Did the industry collapse? People stopped investing there? No, they continue to grow along with this new tax structure. Likewise, government started taxing investment into VPF accounts beyond a particular point. Likewise, in this budget, major changes have been made. See, for example, traditional guaranteed return insurance plan. These were tax-free irrespective of the amount you put in those plans. Government said, here is a tax arbitrage where high net worth individual is making best use of it to bypass the tax. So the government is taxing the guaranteed return insurance plan, which are attracting more than 5 lakh premium per year, and they said it will come under taxation according to the income tax rules. Likewise, there was an exemption which was given in reinvestment of real estate gains from residential properties. Now it has been restricted to 10 crores. So tax landscape keeps changing. We have to adjust as per the evolving tax structure. The government of the day, in its best wisdom, to create a rational tax structure or to plug the arbitrage in the system or to make sure that people do not misuse the tax system to save on the taxes, periodically keeps bringing the changes to the tax structure. So we have to accept it. We have no other option. As obedient and law-abiding citizens, we have to go with this. The professional financial planners will handle this subject as per the established principles of financial planning. Coming back to the question, should you invest in debt funds or not? Should you stop investing into the debt funds beyond this point? The answer is very clear. You should make no changes in your portfolio just because the tax structures have changed. Have a word with your financial planners, have a word with your mutual fund distributor, have a word with whoever is advising you and hear their story. A professional planner will not unnecessarily meddle with your portfolio because of this change. Have faith in the system, have faith in your planners. Debt funds will continue to remain here in your portfolio as before. Dear viewers, hope the video that I have done today helped you to understand what will happen to debt funds in your mutual fund because of this taxation, and it would have put to rest the doubts that could have been there in your mind. Should you invest in debt funds from this point onwards or not? If it did help you to understand the finer points of this particular problem, do like this video. Do not forget to share these videos with your friends and relatives, with the near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another episode of Your Life, Your Money next Friday. Till then, stay safe.
Press the bell icon for more details and subscribe our channel.